Here's something that surprises almost everyone. When someone dies, their bank account doesn't automatically go through probate court. In fact, if it's set up correctly, that money can be in the hands of a beneficiary within days. No lawyers, no judge, no waiting months for a court to decide anything. But if it's not set up correctly, that same account can get frozen, tied up in court, and split among relatives who never even wanted it. Today we're breaking down exactly how bank account inheritance really works, and how you can make sure your money goes exactly where you want it to go. Welcome back to Money Regulation Hub, the channel where we translate confusing financial rules into plain English you can actually use. Today's topic is one that affects literally every single person watching this video, because every one of us either has a bank account now, or will inherit one from someone else eventually. We're talking about what happens to a bank account when the owner passes away. By the end of this video, you'll understand the difference between accounts that skip probate entirely and accounts that get stuck in it for months. You'll learn what a payable-on-death designation is, how joint accounts really work when one owner dies, what role the FDIC plays in protecting inherited funds, and the tax rules that come into play. Stick around till the end, because we're also going to cover a mistake that causes families to lose access to money for weeks, even when the deceased did everything right on paper. Let's get into it. Let's start with the single most important concept in this entire topic. Beneficiary designations override almost everything else, including a will. This surprises people constantly. You might write a beautiful, detailed will, leaving all your assets to your children equally. But if your bank account has a different person named as the beneficiary on file, that account skips the will completely and goes straight to whoever is named on the account paperwork. This is called a POD designation, payable on death. It's a simple form, usually free, that you fill out at your bank naming exactly who should receive the funds when you pass away. Some banks call it a Totten Trust account, named after a 1904 New York court case, but functionally it works the same way nationwide. Here's why this matters so much. A POD account is considered a contract between you and the bank, not part of your probate estate. That means it bypasses the court system entirely. The beneficiary just needs to show the bank a death certificate and valid ID, and in most cases, the funds are released within days. Think about Sarah, a hypothetical account holder. She has $50,000 in savings in a will that splits her estate evenly between her two kids. But years earlier, she'd named only her older son as the POD beneficiary on that specific account and forgot about it. When she passes, that $50,000 goes entirely to the older son. The will doesn't matter for that account. Her other assets get split according to the will, but this account follows its own separate instructions. The lesson here? Check your beneficiary designations regularly, especially after major life events like divorce, remarriage, or the birth of a child. Now let's talk about joint bank accounts. Because these work very differently depending on how they're titled, most joint accounts in the US are set up as joint tenants with right of survivorship, often abbreviated JWRS. In plain English, when one account holder dies, the surviving holder automatically becomes the sole owner of the entire account. No probate, no court process. The bank simply requires a death certificate, and the surviving owner keeps full access. This is common with married couples, and it makes sense. You want your spouse to have immediate access to shared money for funeral costs, mortgage payments, and everyday bills without waiting for a court to sort things out. But here's where it gets tricky. Not all joint accounts include survivorship rights. Some are set up as tenants in common, which is far less common for everyday checking or savings accounts, but does show up in certain business or investment contexts. In that structure, the deceased person's share doesn't automatically pass to the co-owner. It goes through their estate instead, following their will or state inheritance law. There's also a scenario families don't think about: adding an adult child to a bank account just in case. Elderly parents often do this so their child can help pay bills. But here's the catch. Depending on how the account is titled, that adult child could become the legal sole owner of the entire account the moment the parent passes, even if other siblings were supposed to inherit equally. This has caused countless family disputes and lawsuits. If you're helping a parent manage finances, it's worth understanding whether you've been added as a joint owner or just as an authorized signer, because those are completely different legal statuses. So what happens when an account has no POD designation and no joint owner? This is where probate comes in. Probate is the court-supervised process of validating a will, paying off debts, and distributing remaining assets. If a bank account has only the deceased person's name on it, with no beneficiary listed, that account becomes part of the probate estate. This means the account gets frozen. The bank will not release funds to anyone, not even a spouse or child, until the court appoints an executor if there's a will or an administrator if there isn't one, and issues what's called letters testamentary or letters of administration. These are official court documents proving someone has legal authority to act on behalf of the estate. This process can take anywhere from a few weeks to over a year, depending on the state and how complicated the estate is. During that time, bills tied to that account, mortgage payments, utility bills can go unpaid, which creates real stress for families already dealing with a loss. Some states offer a shortcut for smaller estates called small estate affidavits or simplified probate, which allow heirs to claim bank funds without a full probate process if the total estate value is below a certain threshold, often somewhere between $50,000 and $200,000 depending on the state. It's a good reason to check your specific state's rules. Let's talk about something people rarely think about. What happens to FDIC insurance on an inherited account? Quick refresher, the FDIC, or Federal Deposit Insurance Corporation, insures deposits up to $250,000 per depositor, per bank, per ownership category. This protects your money even if the bank fails. Here's an important federal rule. When someone dies, the FDIC provides a 6-month grace period where the deceased person's accounts continue to be insured as if they were still alive, based on the ownership category at the time of death. This gives families time to sort out the estate without suddenly losing insurance coverage during the transition. After that 6-month window, or once the estate is settled, whichever comes first, the insurance coverage is recalculated based on the new ownership. This matters a lot for larger estates. If someone has $400,000 across accounts and it later gets split among 4 beneficiaries, each beneficiary's inherited portion gets insured separately once it's moved into their own name, since each person gets their own $250,000 coverage limit. This is genuinely useful federal protection that most people don't know exists, and it's worth mentioning to any family currently handling an estate. Now for everyone's favorite topic, taxes. Here's some good news. At the federal level, inherited bank account funds themselves are generally not considered taxable income to the person receiving them. Unlike inheriting a retirement account with pre-tax contributions, a basic checking or savings account doesn't trigger federal income tax when you inherit the cash sitting in it. However, and this is important, any interest earned after the date of death is taxable to the beneficiary once the account is in their name. So if you inherit an account and let it sit for a year earning interest, that interest counts as regular taxable income. There's also the separate issue of federal estate tax, which only applies to very large estates. As of 2026, only estates exceeding roughly $13.99 million per individual are subject to federal estate tax. So for the vast majority of families, this simply isn't a concern. That said, some states have their own estate or inheritance taxes with much lower thresholds, so it's worth checking your specific state's rules. Since state law varies significantly here, let's make this practical. If you're the beneficiary of a bank account after someone passes, here's generally what banks require. A certified copy of the death certificate, not a photocopy. An official certified one, which you can request from the county vital records office or funeral home. Valid government-issued photo ID for the beneficiary. If it's a POD account, you may also need to complete a claim form provided by the bank. If it went through probate, you'll need those letters testamentary or administration we mentioned earlier. Most banks process straightforward POD or joint account claims within a few business days once documents are submitted. Probate-based claims naturally take longer because they're tied to the court's timeline, not the bank's. Let's bring this all together. First, beneficiary designations on bank accounts override your will. Always keep them updated. Second, joint accounts with right of survivorship pass automatically to the surviving owner, but make sure you know exactly how an account is titled before assuming this applies. Third, accounts with no beneficiary and no joint owner get frozen and go through probate, which can take months. Fourth, the FDIC provides a 6-month grace period of continued insurance coverage after someone's death, giving families breathing room during the transition. Fifth, inherited cash itself generally isn't federally taxable, but interest earned after death is, and federal estate tax only applies to very large estates. The single biggest action item from this entire video. Go check your own bank accounts right now for beneficiary designations. It takes 5 minutes and could save your family months of stress later. That's how federal law and bank policy handle account inheritance. If this video helped clear things up, do me a favor and hit that like button. It genuinely helps this channel reach more people who need this information. If you're new here, subscribe, because we break down confusing money and banking topics like this every single week. Drop a comment below. Have you ever dealt with an inherited bank account or found out too late that a beneficiary designation wasn't updated? Your experience might help someone else watching this. And if you know someone who's currently an executor or dealing with a loved one's estate, share this video with them. It could genuinely save them time and stress. Coming up next, we're diving into a topic that trips up even experienced investors. How the FDIC actually calculates coverage limits when you have multiple accounts at the same bank. If you think $250,000 is your total limit no matter what, you're going to want to see this one. Thanks for watching Money Regulation Hub. I'll see you in the next video.